Welcome to this video comparing real estate and dividend stocks for building passive income. We'll explore which path is the best fit for your financial goals. The big question is, where should your money work hardest for you? Both real estate and dividend stocks are proven paths to passive income and building wealth, but they operate very differently. Real estate investing involves owning physical property to earn rental income and appreciation. Key advantages include control over a tangible asset, steady cash flow, and tax benefits like depreciation and deductions. Dividend stocks involve owning shares of profitable companies that regularly share a portion of those profits with you, the investor. This provides passive income with quarterly or monthly payouts, and no property management is required. Startup costs are a major difference. Real estate has a high barrier to entry, often requiring $20,000 or more for down payments and closing costs. Dividend stocks have a low barrier to entry, allowing you to start small with as little as $100. In terms of income potential, rental yields typically range from 4 to 8% annually. Total return for real estate, including appreciation, is estimated at 8 to 12%. Dividend yields are often 2 to 6%, with a total stock return of 7 to 10% when combined with capital gains. Liquidity is another key factor. Real estate has low liquidity. Selling a property takes months. Dividend stocks offer high liquidity. You can sell shares any trading day and access cash within 1 to 2 business days. Both investments carry different risks. Real estate risks include vacancy, maintenance surprises, and market downturns. Dividend stock risks involve potential dividend cuts, price volatility, and the emotional risk of panic selling. Both strategies offer tax advantages. Real estate offers depreciation, mortgage interest deduction, and the 1031 exchange. Dividend stocks benefit from qualified dividend rates, IRAs, and tax loss harvesting. The time and effort required vary significantly. DIY real estate requires 10 to 20 hours per month. Passive dividend stocks or real estate through REITs require 1 to 3 hours or less per month. Real estate offers full control over your physical asset and provides a strong inflation hedge, as rents can be raised. Dividend stocks offer minimal control, but diversification can provide broader protection. Dividend stocks excel in diversification, allowing investment across many sectors with minimal capital. Real estate diversification is limited, often requiring large investments in a single property or market. This head-to-head comparison summarizes the key differences, covering startup cost, liquidity, effort, tax perks, control, inflation hedging, diversification, and volatility. Choose real estate if you have large capital, enjoy hands-on management, desire a tangible asset, are investing long-term, and are in a high-demand market. Choose dividend stocks if you have limited capital, prefer a hands-off approach, need quick access to money, want global diversification, and wish to invest from anywhere. The smart move is to do both. Start with dividend stocks to build capital, then add real estate once you have enough saved. Finally, reinvest all your income back into both assets to maximize compounding and wealth building. There is no perfect answer, only the right fit for you. Both strategies compound wealth over time. The best investment is the one you start. So start small, stay consistent, and reinvest.